Oh, hello everyone. It's Susie from Esoteric Trading Solutions. I hope you're all well. I hope you're looking after yourselves, you're living your life according to the way you want to live it. I hope you're being kind to your family and your friends. You're looking after your putty cats, your animals. You're looking after just yourself, particularly in this world. It's always very hard. And please, do look after just people and strangers generally in the world, just to make this place a better place. Honestly, it's getting harder and harder. Look, I thought today I'd look at markets overall. What I'm seeing is really scaring me a lot. And I'm sorry if I keep looking up at another screen. I've got my recording screen here and I've got my other computer up here, the next one up. But what I'm seeing in markets is really, really frightening me, I've got to say. And I'm just, really going to outline some stuff. I've got no slides prepared or anything like that, but I'm just going to take you through yield curves and interest rates, credit rates, basically equity markets, bond rates, obviously foreign exchange and economics. But the biggest things I want to say is obviously New Zealand cut rates the other day by 50 basis points. We had the Reserve Bank of India cut rates by 35 basis points. The Philippines are going to go tomorrow. We've had Thailand go. We obviously had the Fed go the other day. Australia's been looking at cutting interest rates for some time as well. And, you've got to question what's going on here, particularly when US equity markets are at all-time highs, saying that growth's okay, when the bond market is particularly saying that growth isn't okay. Now, the bond market generally, in terms of professional markets, is seen to be much more ahead of the curve than, say, the equity market, which is full more of retail punters per se than the bond market is. So something's wrong here. And like I'd said to my friends, just in Australian, terminology, something's wrong in Toot Garook. Seriously, the markets do not make sense. And certainly the equity market should not be where it is, given where bond yields are at the moment. Now, bond yields are extremely low in countries where there is not currency collapse or devaluation. In countries where we see currency devaluation or collapse, bond yields are right through the roof, okay, like Argentina, for example, which is now, and Venezuela, which are now actually selling their petrol in terms of, petrol cryptocurrency and the like. But if we look at bond yields and we look at the US particularly, and we'll take it right down, and I'll just take you through bond yields, it's a scary picture given what we're seeing in equity markets, particularly US equity market. US equity market saying that there's growth, is doing very well. Everything looks great. But when we look at bond yields and cash yields globally around the world, something is seriously wrong. Now, cash yields are being cut. Official cash rates are being cut because economic conditions are very bad. Consumer demand is very bad. The trade wars are very, very concerning. So New Zealand cut rates the other day because they cited trade wars, particularly with the US and China. It's going to actually, impinge on growth globally. And they also said that, global demand was becoming less and less, obviously. The IMF, the International Monetary Fund, reduced global demand from 2% down to 1.5% about 6 months ago. But, New Zealand cited, trade wars as a real concern for economic world growth. If there's trade wars, basically, there's basically protectionism. With protectionism, you have a slump in world growth. And that's what we saw in the Depression. Going back in the 1920s, okay, 29-30. There were trade wars, prohibition, tariffs, which basically means if you want to buy a Chinese good or whatever, it's going to cost you a lot more than your own goods in your own country. Now, that's going to reduce basically economic growth globally. And seriously, trade wars and tariffs could take the whole world into a global recession. And that's certainly what bond yields are telling us at the moment, okay? For sure. So if we look at bond yields, we look at the US curve, for example, start with that one, 3 months is 2%, just over 2%. Then we've got basically inversion. And what that means is the longer yields here, 1, 2, and 3 years, are actually lower than the short rates, okay, than the shorter rates. They're actually lower in yield. Now what that basically means is this US curve is saying there's going to be a recession in 3 years' time, okay, in 5 years' time. So essentially the cash rate is going to be a lot lower. And essentially, 5 years out, you're going to get a lower interest rate than you're going to get in the short term. And that basically, when you've got yield curve inversion like that, it's essentially saying a recession. What we've got is between 1 and 30 years, it's a positive yield curve. And that's generally what you'd expect with a rate cut, a positive yield curve. But generally when the market is thinking about a recession, you tend to see the yield curve inverse, okay? In other words, the 1 month rate being higher than the 3-year rate, for example. And that's an inverse yield curve. Now, the equity market, the US equity market is going, basically, what happened there? The US equity market is essentially pricing like there's no depression at all or no recession, and that is just not correct. Now, the problem with equities, as you know, with any of the models that come out, any of the valuation models for stock, they always look at the cash flows, the discounted cash flow, looks at the cash flow from the business and will discount it over an interest rate. And if that interest rate gets lower and lower, like for example 10/1, so the interest rate's 1, the cash flow is at 10. But if the interest rate's at half, the cash flow becomes 20. You see what I'm saying? So basically, the equity market will continue to increase prices because the interest rate is going lower and lower. But the reality is, if you've got world growth coming off dramatically like we're seeing, you know, how can you say that equities should be higher in terms of price? Something just does not make sense. And I particularly believe that the bond market is actually correct, that we are going into, the yield curves are right, and that we are going into a global world recession. And certainly President Trump's tariff policy with China will do that, absolutely. China basically, you know, literally is so big as an economy now, 1.3 billion people, 1.5. They can basically dictate world growth. They certainly have an effect on Australia. They're one of our largest exporters, and they're having an effect on the New Zealand economy as well. And they'll have an effect on global economies. So, you know, if you go back to economics, back to the Depression in the 1930s, you'll find out that there was protectionism and tariffs, and that's what led to a global depression. And certainly the yield curves that we're looking at the moment and where outright yields are, that is certainly telling us there's potential for a global recession or / depression. Now, I've said this some time ago, it is very concerning. And if we look at yield curves right across the board, okay, exclude, as I said, countries where there's basically the currency's fallen out of bed, because what happens there is currencies will raise yields basically to try and prop up their currency. And we've seen that in Argentina, Venezuela, and Turkey. So exclude those countries. But any other country where things are normal, they don't have a currency that's going down dramatically, you'll find there's still, very, very low interest rates, okay? Now, even in Australia, we've been known to have high interest rates. You know, our yields now are literally, the 10-year yield's below 1%. It's just literally unknown. I mean, there's a crisis here. And the crisis is, if yield curves get to like a Japanese scenario where they're less than, 0.5% or 25 basis points, cutting yield curves is not going to do anything when we talk about world growth. It's not going to do a thing. All it's going to do is prop up the equity market, and it's not going to do anything else. And something's seriously wrong when you've got global recession or depression globally, and yet the equity market, the US equity market, is still going up like there's no tomorrow. It doesn't make sense. If we go to Europe, for example, Austria is negative yield curves right out to 15 years is negative. I mean, that's incredible. If you look at Belgium, same story. Forget about the Brazil. Again, they've got currency crisis. If you look at Canada, again, yield curves are inverse from 1 month down to 30-year Canadian bond rate. Again, inverse yield curve implies there's going to be a recession, a big one, okay? Even China, yields are starting to rise in China because we did see a devaluation in their currency, okay? Devaluing their currency makes Chinese exports cheaper. So if I want to buy Chinese goods, because their currency is devalued, it's going to cost me less money to go and buy their goods, okay? And that's what they're trying to do to offset the tariff policy of Trump, okay? But with a devaluation in currency, China runs the risk that interest rates will start to rise because the currency could devalue quicker, okay? In other words, their currency goes down, and it becomes so cheap that they start raising rates, China, to prop up the currency. And that is a real risk for China. because also what that means is if China's currency devalues, means when they go overseas, they have less spending money, the Chinese, okay? But it also puts them in a very competitive advantage if they sell goods to the rest of the world. It means their goods are cheaper than anyone else's because their currency is devalued, okay? In other words, I've got an Australian dollar of, say, $1, and now, rather than me being able to, you know, it was going to cost me 3 renminbi, or 4 or 5 or 6, now it's going to be a lot cheaper for me to buy something in the Chinese market, okay? Rather than it cost me, say, 5 renminbi, it's only going to cost me 4 in terms of the Australian dollar. You see what I'm saying? And it's the same with the US. One US dollar is now worth 7 renminbi, whereas before one US dollar was only worth about 5.8 renminbi. So again, it makes it cheaper for the US now to basically pay in US dollars. China have done this to try and offset the tariffs that the US have put in place, okay? It's a very, very scary story what we're seeing here. Now, if we go to the rest of the world, we are pretty much in Europe seeing very, very low interest rates or even negative interest rates. If we go to Denmark, we are seeing negative interest rates right from the 3 months through the 20 years, okay? Again, France, very low interest rates, negative right through to 15 years. Scary stuff, man. Even Germany, we have negative yields right out to 30 years. It's scary. Now, what that means is basically investors don't get an interest rate. You know, if you've got a bond, it's a negative interest rate, right? You don't get anything on your investment, nothing. In other words, if you want to put money with Switzerland, with a bank, you're actually paying the bank because it's negative interest rate to keep your money there. You don't actually get a return on your money at all, full stop. You're actually paying the bank to keep your money there in safe holding because interest rates are negative. Okay, now that's scary if you've got a deposit. Okay, if you've got a deposit, you're paying the bank to keep your money there. If you're borrowing money, it's costing you nothing to borrow. It's actually negative. The bank's giving you money. Now, see, it's all arse around, okay? It's really, really scary stuff. Now, we've still got the problem, in Greece, where Greece can't pay back their debt. We've got the problem in Italy, where, Italy can't pay back their debt. Now, don't forget, Italy is the 3rd largest bond market in the world, okay? Nothing's changed. Italy is still getting, wrapped over the knuckles by the European Central Bank to get their balance sheet and their income statements in order. They're borrowing too much. They don't have enough growth. They don't have enough exports. They're not paying their debt. Now, if the Italian bond market collapses, all hell is going to break loose because, as I said, they're the 3rd largest bond market in the world, okay? And if they don't pay back their debt, it's going to be massive credit and sovereign default, and it's just going to be, hell will break loose, okay? Now, we have seen India cut rates 35 basis points, which was a shock. Again, you go to other European countries, and even in Italy, the yields are still low, but if these guys don't pay back their debt, these yields will go up through the roof, okay? Now, the European Central Bank, is trying to get Italy to get their balance sheet in order, their borrowings and some sort of fiscal responsibility, but that's not happening. Now, the biggest problem, again, I see with the interest rate policy is eventually it's not going to work. I mean, it's fiscal responsibility that's going to get the economies through what they're doing. It's not interest rates. Interest rates will not work. And we've seen that in Japan. Japan's had low interest rates and now negative interest rates for so long. And, they've tried to cut and cut and cut to get economic growth. And you just haven't seen it. And that's the biggest risk we see in the world economy today. That, central banks, the Fed Reserve or whatever it is, or Australia or whatever, they're all trying to use interest rate policy to cut rates to get economic growth going and happening. But it's not being seen in the bottom line. You're not seeing it through businesses or anything else, okay? All you're seeing is the rich get richer and the poor are getting poorer, okay? And it's not feeding through to employment opportunities or growth opportunities or businesses growing. And that's a very concerning thing indeed, as far as I'm concerned. And certainly with tariffs, which is basically trade restrictions globally, that is going to reduce employment globally. In other words, people will lose their jobs. If people lose their jobs, basically they have no income, they're on unemployment benefits, they do not pay tax, and they do not spend. The American economy is run by 70% consumer demand, and if consumers are not spending, the American economy will slump, and that will be seen through the equity market. The equity market should not be where it is. This is scary, and the markets at the moment that I'm looking at are very scary indeed. To me, this smells of 2008, 2009, and it is scary for sure, because I do believe equity markets can really fall from here dramatically, particularly the US equity market. And certainly I believe what I believe the interest rate curves globally are telling me that story is going to happen, okay, for sure. Now, as I said, again, where there's problems with currency, like in Mexico, you will see much higher yield curves because governments will raise rates to protect their currency. Just like we saw, as I said, in Venezuela, Argentina, say in Zimbabwe, the currency collapsed. Again, rates are through the roof. Again, high inflation, currency woes, okay? And you'll see it in all those countries where there's big problems. Again, Netherlands, as in Europe, the yield curve is completely negative, okay? Completely negative in yields, I should say. And basically, this is a positive yield curve. If you look at the 1 month, it's basically minus 0.6 to 30-year minus 0.08. I mean, it's just incredible. Even New Zealand, which was a high yielding currency, again, is not high yielding anymore. And even the 20 years at 1.48%. And they have cut, as you know. Very scary story indeed. Very scary story. So if we go to Poland, again, fairly low. Portugal's another one to worry about. Portugal and Spain have huge debt, and there's a risk that their yields could go much higher than this if they don't pay back their debt, just like Italy, okay? There's countries in the Euro, in the European Union, there's 17 countries, and Portugal, Spain, and Italy are in the Euro, and basically their debt is huge, and they still have not repaid back their debt. So to some degree, their interest rate should not be as low as other European countries, okay? And that is a risk in itself, absolute risk. Also, Russia, another story. Russia are trying to trade outside the US. They're trying to set up their own settlement system. They're trying to trade much more with China. So they don't have these US sanctions put on them, where they don't have, US will put sanctions on them, close down their ability to access their accounts in the US, where they can't get their own money, where they can't get access to their own bank account money and that sort of thing. And the Russians want to trade outside the SWIFT system, okay? Really, really important to keep that in mind. Russia's in trouble at the moment as well. Globally, it's certainly looking in a recession. When you look at the economic figures, it doesn't look good at all, okay? So let's just go quick going through here. South Africa, another story in itself. Things don't look too good in South Africa. Spain, again, rates should not be this low given their history of paying back debt. Spain has terrible growth prospects at the moment, and they don't, there is a risk that they may not pay back their debt and default on their debt payment to the European Central Bank, okay? And again, Switzerland, negative rates right across the board. So if I'm a depositor and I want to give money to a Swiss bank, I have to pay them to put my money in the bank. Thailand, same story, just cut rates, looks bad. Turkey, currency woes, currency defaulted, rates are rising. And that's what you see when you have a currency collapse, interest rates rise and inflation goes through the roof. And that's potentially what we could see globally as well, in my mind. You can have a situation where you've got a massive recession with high inflation, with high yields, okay? And I believe that inflation is in the system, that what we're seeing through the central banks and through the statisticians and the rates that come out in terms of economic growth and inflation are not correct. Inflation is here. When you look at your school fees, when you look at, the cost of food, when you look at your utilities, when you look at all sorts of things, inflation is in the system. And I don't believe what I'm seeing being published by the economists or by the economic, statisticians. Inflation in my mind is in the system, and the yield curves and the yields are not reflecting the true nature of inflation. And that's what I believe. Okay, so globally we do have low interest rates, except for countries where there is high interest rates because they've tried to support their foreign currency and they have high inflation. So if we look at the equity market, there'll be another story, and that story is like everything is, you know, fantastic. Everything looks great, but it doesn't. Globally, things look terrible, and there is a real risk that we're going to see, you know, an equity market collapse as well. And I think, and I believe it, we're starting to see it now. And in my mind, cash will be king, literally, because we're going to see much more risk in foreign currency markets, much more risk in equity markets. Yields will go lower and lower in countries that are seen as safe haven, like the Norwegian, Denmark, Swiss, Scandinavian countries, as well as Japan and the like. And in other countries that are not safe haven, yields will go higher and higher. We're now starting to see credit spreads blow out. The cost of funding is starting to blow out. Debt, there's a lot of debt in the world that's under zero, and, you know, it doesn't make sense. Companies are highly geared at the moment, and yet debt in terms of interest rates is under zero. Something has got to give here. We've got the US equity market at all-time highs, and if you look at the revenue line, revenues are not going up. It's just profit that's going up, which is a reduction in expenses. This is scary, guys. This is really scary. Now, if we look at the US dollar against the yen, we have seen over time, literally from 1994, it's gone up, and then it's come all the way down to around 75, back up to 126 odd, and now we're looking at it around about 106. Now, it's quite conceivable that as the US equity market continues to sell off, they sell US dollar equities, and the US will come off because of that, the US currency. Also, Fidelity reported today that they were going to move out of a very large holding of US equities, 200 billion, and go into international equities because they're cheaper. Now, if that's the case, there'll be weakness in the US dollar, and obviously there'll be strength in other currencies, depending on which currencies they go into, which is a strategic change for Fidelity particularly. Now, if we look at the equity market, now, in 2008, 2009, as you know, there was huge declines in the equity market, where we pretty much saw the equity market pre-2007, it was around 14,000. In 2008, 2009, it got around 5,800 to 6,000. And then now we've seen nothing but a parabolic move straight up to 27,500 odd. So I'll just get up the chart so you can have a look. And this is what I'm very scared of, because something is very wrong when we've got a bond market telling us one thing, or the interest rate market telling us one thing, and the US equity market telling us another thing. And I believe that pretty much the bond market, the cash market is correct. Okay, so just pulling up the Dow, let's just see within trade views what the code is here for that. Bear with me for a minute. What's the code for it? Here we go. The Dow. Whoops. Here we go. Dow Jones Industrial Average. If we have a look at the pretty much the monthly chart, if we go back to 2008, 2009, actually 2008, just after 2007, it started selling off in January of 2008, and actually got worse right up until June 2009. Trading Views got it around 6,000 or when it got there, but I sort of vaguely remember that the futures, equity futures, got down to about 5,800 at the time. I was actually in markets at the time, and it was the most scariest thing I've ever seen. So equity futures got down to 5,800, and now what we've seen pretty much in US equity markets is a parabolic, literally parabolic straight up to these lofty levels of, what was it, 27,000. So according to the technicals here, we pretty much have a triple top here. 1, 2, 3, 4, 5, 6, maybe actually 6 tops. And in my mind, it's sort of in this range here, but if you put a line straight through there, the uptrend has broken. And I do think with trade tariffs, particularly with China and the US equity market is very vulnerable. Now, as I said, the US is a consumer-led market, particularly in terms of the economics. 70% of the growth of the US market comes from the domestic market, 70% consumer-led. And basically, you see a consumer-led market. Now, what we'll start seeing, obviously, is consumer demand coming off quite dramatically, and you'll certainly start seeing it through consumer staples and the like. And I do believe the equity market is vulnerable. Now, what does that mean in terms of cryptocurrency markets? Well, what it means is, and we've certainly seen it in the last week or two, we've seen buying of Bitcoin from the Chinese because their yuan or their renminbi has been so volatile, and it's gone up to 7 from 5.8 to the US. So basically their fiat currency has been a lot more volatile, and they've been buying Bitcoin. We've certainly seen stabilization in XRP, and particularly going forward, what we could actually see is more volatility in fiat markets. And I've said this in other videos way back, probably 6 months ago, where the volatility is so extreme that professional investors as well as retail investors start investing in cryptocurrency. Now, what we're seeing on the balance sheet side for corporates and sovereigns is basically corporate spreads or funding on the debt side is starting to move out. It's starting to move higher, where it's going to cost a corporate more now to potentially borrow money. Even though the base curve is negative yield curve, the corporate has to pay a credit spread. Now, if credit spreads on the debt side start rising, then equity cannot stay where it's going to stay. Equity at the moment is quite expensive, and equity will start to get more cheaper. In other words, equities should start to sell off, which will then precipitate also a US dollar sell-off. So what I suspect is we will see more volatility in fiat markets, absolutely. And I do believe that there will be a transfer from fiat markets to cryptocurrency markets. We're certainly seeing it with Bitcoin having a 68% dominance, and we're certainly seeing it with XRP maintaining that 31 to 32 cents. So, there is something wrong in fiat markets at the moment. I do believe there is a risk of a big recession, even / depression, I'll say it. And I think inflation's in the system. I think yields are way too low. They're not showing the right story. I think central governors in the world shouldn't be using monetary policy. They should be using fiscal policy to create jobs, not monetary policy. And I think, watch out, because we're going to see a huge volatility in these fiat markets. And we could find that the volatility in fiat markets is actually more than in cryptocurrency markets such as XRP and Bitcoin per se. So anyway, guys, I hope you enjoyed this. Thank you for listening. I'm sorry I haven't done a video for a month, but I have to be inspired. I'm back in Australia at the moment. I was in Europe, and thanks for listening. Please do look after yourself. Be kind to yourself. Be kind to your parents, your friends, all your loved ones. Please be kind to your animals, your putty cats, your dogs, whatever animal you've got. Give them a kiss. Please be kind to people in the world just generally to make this world a better place. It is a hard world, a lot of depression, a lot of mental health issues out there, a lot of poverty. 4.1 billion people are in poverty out of 7.7. It's pretty terrible. It's a crime against humanity as far as I'm concerned, and the rich tend to get richer and richer, which is pretty bad. But please be kind to yourself. Please make this place just a better place for all of us. We're all blood and water, and it's hard for everyone. Thank you very much for listening. I'm Susie. Cheers, guys. Thank you. Let me just turn this off, guys.